Good evening, everybody. My name is Daniel Young. I'm the owner and founder of Adapted Perspective and the Adapted Perspective social media platforms. And I am back to talk about our stock market investment strategy using closed-end funds. Now, I I made this video last week, and maybe not this particular video, uh, but a lot of what's on this video, to be honest. I made it last week about midnight on Sunday, and my computer froze, and I was not in I didn't have the mental capacity to run the same video or attempt the same video again at 1 o'clock. Um, so I gave it up, hoping that I would get to it during the week. And then the week just turned out to be rougher than it had been, or at least rougher than it had been for a while, maybe. Just too much going on and a lot going on. Um, it's one of those financial seasons for us. It just seems that I put it to my wife this way. I wish it's like we'll get there. I'm waiting on the time where I'm waiting for a time where it feels like we're not bleeding money. Car repairs and then more car repairs and then this and then that and that it just keeps going. Um, and you end up with financial seasons in your life. And um, the if I put it nautically, we're all sailing on different journeys. We're all sailing on the same general sea, but how you perceive the sea is different. Like we're all out there, we're all sailing. I imagine myself sailing a pirate ship, or at least like a loaded down galleon. Um, had you asked me 20 years ago, I probably would have said the same thing, but in reality, I was uh, deluded. I probably years ago, it probably would have been more like a wooden John boat or a wooden dinghy. Just not much to my name, thinking I could do everything and at the same time having not much at my disposal. Um, but I mean, age and experience and everything else, you learn and you grow and you keep going, and that's pretty much what we're all tasked with, right? The Everybody has a different way to sail the seas, and we see the same thing in the stock market, um, which we'll get to in a little bit. But it's we're all called to sail the ocean, but how you sail it and how you perceive it and where you think you're going are all different. Most people think they're sailing the ocean toward retirement only to come up empty. You'll be lucky to see your treasure island, but chances are you'll blow by it and never realize it happened. Uh, our vision exists in the distance, and it's always beyond our line of sight. So if uh, pick your galleon, right? Pick your boat. I mean, you could pick a cruise line boat. It really doesn't matter what it is, just how you envision yourself sailing the ocean. If you climb to the tallest point on your ship, or like the crow's nest out of a old wooden Spanish galleon, the farthest thing that you can see is still the edge of the horizon. But even at the edge of the horizon, that's still in your line of sight. You may not see it as clearly as what you see 20 feet off the bow of your ship, but it's still there. Your vision exists beyond that. So how you sail the seas, or yeah, how you sail the seas matters. How you deal with the day-to-day finances matters. How you go about investing matters. How you get it all to work together matters. And some people, a lot of people, never put the pieces together. They see things as individual parts, not pieces as part of a whole. Or it's kind of helter skelter, like they're sailing here and there, and they're very reckless. I mean, the whole point of sailing is to get better at sailing. You dodge the storms. Some storms you can't go around and you can't shelter from, so you have to sail through. But if you can dodge the sandbars and dodge the wrecks and dodge the reefs and learn to do a better job in the day to day, it's not to say that all your problems go away. You just get better at solving problems and recognizing problems. Like what can I deal with and what can't I deal with? And I'm going to have to deal with this. So what's the best way for me to deal with this? And the more you're interested, or maybe the more you're forced to do it. I mean, your interest doesn't so much matter because it's going to happen on its own anyway. But the more you take on the responsibility of guiding your own journey and employing your knowledge and using it, which would be wisdom, then the better you get at sailing. It doesn't make it perfect. It doesn't mean all your problems go away. You just get better at managing it. So in the midst of a financial season of just, it feels like God, like it does. It feels like we're bleeding money and trying to make it work, and we are making it work. It's forcing us to use our wisdom and knowledge, or our knowledge and wisdom, and it's think of how to say this. It's forcing me to not so much alter the overall vision and strategy. It's forcing me to get better on the day to day and forcing me to get better at planning the day to day. I mean, because face it, you're going to spend a ton of money on the front end. You're going to have to have a plan to refuel or restock. And it just happens. I mean, we're shifting money around, trying to get our finances better arranged. It just happens that all the car stuff is happening at the same time. So it's forcing me to make sure the strategy we're implementing is the best thing. So yeah, I'm off on my tangent. So I did this video last week, and I, I wish I had the proof of it, but I don't. I didn't take a picture of my paused video screen, but of my normal tie-in and my normal opening, I know I'm really off base, so I apologize. I mean, normally I talk about stock market stuff and not all the rest, but in facing the week, it was a problem-solving week. Video didn't work. I had tasks set before me, and a lot of that didn't happen, and it ended up being a lot of other stuff. And we all have weeks like that. So I'm sorry I didn't get last week's video out, and I'm sorry my plans for the week got diverted, but such is life. We do the best we can, we keep sailing. So this week, I mean, it's not the same stuff as last week, but this week, here we go. So the normal disclaimers. It's an unedited video. Who knows what you'll hear in the background as I film these in my house. And in theory, not much because everybody's kind of sequestered away. I'm not a financial advisor. I'm a financial strategist, and I don't speak like the herd. And I don't speak like the herd. I walk in limited company, and sometimes I walk alone. So, of my goals for the week, my original goals: work on my books, help my wife in her strategy, um, update our business, like update all that stuff, and not really none of that happened because I was tasked with other things this week. So hopefully this is a great reset looking forward in the sense of it's routine. I make this video Monday. I've got to track our expenses for November, which is now 2 weeks late, and then catch up on December. Um, and I get that that's not exactly stock market based, but that is my week. If I can get through that, then I can get back to writing. And what I found in writing, I saw something cool online. I made a strategic decision to use it, and it kind of backfired on me. So I'm having to go back. Between books, I finished the 12 Steps to Financial Freedom, and I, sidestepped stage right and started the closed-end fund specific strategy book. And I changed the personality of ChatGPT. Now, I use ChatGPT not as my content provider. It's not Chat's writing the book and I'm slapping my name on it. It actually bothers me when people do that. So this is and I've used both Chat and Grok, and for book stuff, I like Chat better. Excuse me. So I changed Chat's personality, and I say he, but it's really it. It became obnoxious and the goal was to help cut through some more fluff, but it really became acerbic. And instead of getting my head shaved, it was more like getting my head cut off. And it just got so bad, I had to go back and redo the personality to where it was still fluff cutting, but at the same time, not a guillotine. And I use chat as an ideas board basically. Like, here's what I already have in your extensive knowledge of finance and what everybody else has put through here, what you find online, right? Uh, Give me feedback, but give me constructive feedback. And it ends up being an ideas board. I send an idea, it responds with ideas. I don't take those as just like the last thing, and we bounce things back and forth. And chat ends up being an ideas board, a proofreader, an editor, uh, and something that forces me to see things differently. It'll take my ideas and just automatically write its own book, or it'll write its own chapter, but it doesn't speak with my voice. And when I made it, quite honestly, and when I made it asshole chat GPT, it turned into an asshole. So I got to a point where I just couldn't keep dealing with that personality. So I changed it, which means I had to go back and edit what I'd already written or what I'd written with that jerk version of ChatGPT. So that's been a process. Because I like some of the stuff that came out of Jerk Chat, but I didn't like that personality. So in doing so, I think I have a better book because it's a blending of ideas, but it's getting things back into actually it's my writing style and my voice and my narration. So that's been a process. I also realized it was it was adversely influencing how I script out content because I when I organize these videos, I take content from like across the pantheon of finance, and it's sometimes hard to find a way to narrate them all together and not just read them off one by one. So I got used to ChatGPT like assimilating my thoughts, and it's not a great thing to do. Now, I'll confess that it's not the best thing to do. It's great to have it help organize thoughts, but it's also like chat wanted it to become chat's video. And that's not me. So I'm trying to find a happy medium of the stuff that I specifically want to talk about that's also not going to take an hour long to get through. Um, and that's not to say that what I have to say isn't important. It's to say that I'm hoping I can say it faster than that long. So this is my first attempt breaking out of that. I don't know, just felt like Chinese handcuffs. Like I felt boxed in. I couldn't spring my face myself free. So I'm going to try to hybrid model it. It's I've got notes and I've got other stuff I want to say, and we'll see how it goes. So the week in review, lots happened last week, but really all of that stuff, everything that happened for the most part, is just noise. And noise doesn't change things. It doesn't alter this long-term income strategy that we're effectively using, right? So noise doesn't change that long-term income strategy that's built on high yield assets and the accelerating growth in the US economy. So if we break down the overall strategy, like if we break down the entire system, we come away with three key pillars or three key takeaways. We're creating a no withdrawal portfolio that's built on high yield closed end funds. That's our engine. That's our real vehicle where the principal stays invested and the income pays for life. And when I say no withdrawal, it's not that we're not taking money out. No withdrawal is the principal stays invested. We're not making withdrawals, right? But that's not to say that you can't sell stuff. It's not a buy and hold and nothing ever gets sold. It's you're buying, holding, selling based upon big picture vision of where you think the market's going. And the baggage you need to cut, like if currently it's a bond market, if that environment changes, then you face the ongoing question of should I sell it or not? And if you sell it, fine, you push the money forward into your next investment. So we have funds in our portfolio that are marked for long term or even lifetime, but that's still based on where I see the market's going. If the market takes a weird turn, we'll adjust. We also have funds that are set for sale at 20% growth. Could be ideally it's at like 5% ish on dividends and 15% growth, but it's really however that 20% breaks down. So we have other funds that are earmarked for sale at certain price points, right? But when that happens, the goal is not to withdraw the money. The goal is to push that money forward into the next investment. So, regardless of the market, our job is to build income, not trade based on headlines. Because closed end funds are, gosh, the yields on closed end funds are almost 7%, not 7%. The yields on closed-end funds are nearly seven times that average of what you get in the S&P. Like the S&P 500 average dividend is 1.2. Average closed-end fund dividend is close to 8.5. That's a huge advantage in our favor. So the goal is that we scoop deals now in the current market so that we get that accelerated growth and so that our future dividends compound harder later on. If you can scoop an amazing deal right now with the vision that the direction the market's going to go, with the vision that that's going to continue to increase in value and pay you a fat dividend along the way, that's what we want. Big idea too. America is entering a new industrial age of AI, data centers, reshoring funds, and infrastructure. And every single one of those things runs on energy. And what frustrates me is how different analysts see the energy market as a single entity sector, like it's its own thing. But every company uses AI, every company uses energy. It's really hard to pigeonhole ourselves into energy as just this one thing, right? AI needs all this computation structure, which requires a massive electricity load. It also generates a massive electricity load. And in that electricity, more companies are moving to natural gas as a coolant agent over water. Okay, we need more pipelines to get natural gas from production to conversion to where it needs to go at data center. That means we need more pipelines. That means we need more overall transmission upgrades. Then you get into manufacturing, right? We need more oil. We need more natural gas. You've got to transport it from A to B to C. That also impacts our supply chain. If we're buying a ton of foreign oil because we're not producing a lot of domestic oil, that really puts us at the mercy of the supply chain. But if we pump our own oil, it's still supply chain related because you've got to get it from where it's pumped out, refined, and where it needs to go. But it also decreases our need of foreign oil. So that I think on my end, that would positively impact our supply chain because we're decreasing our need on foreign countries. And then you have this reshoring of wealth, right? And as more income, more investment comes into the US, we get more construction, more manufacturing, more steel needed, more oil needed, more this needed, more that needed, more utilities needed, more energy. And all of it is energy based, and all of it is AI based, and all of it is tech based. We've got to get away from the one dimensional portfolio in a can bifurcation categorization of how things are invested. You have to, because yes, oil is part of the utility market and it's part of the energy market, but it's really just oil. Everything is influenced by oil. Everything. And yes, it's like its own thing, but it's also how companies use it, right? I'm getting ahead of myself. But instead of just looking at oil, we want companies who are going to use it and really supply that end-to-end energy like we need. But of those pillars, so the first one is the overall concept of a no withdrawal portfolio. The second one is this industrial age that needs energy. And the third one is we have to look at we have to look beyond individual sector strategy. And regardless of the noise, right? The current and the water motion is always moving, right? The noise outside or in and around your ship is going to change day to day. So if we ever have to adjust where the targets in the market, we'll adjust. But currently, it's merging it's merging sectors through closed-end funds. But what that means is we're looking at bonds and bonds proxies like municipal bonds, business development companies, real estate investment trusts, and utilities. We want end-to-end energy. So we want production, refinement, transportation, and ending. And then we want tech beyond the big guys. Like, yes, Alphabet, Amazon, Apple, Tesla, IBM, Taiwan Semiconductor. We want technology and AI infrastructure beyond the big guys because the people who are going to see the most benefit are the middle and the small guys, or the mid level and the small guys. So instead of just pigeonholing ourselves in specific sectors or with one company, like instead of just buying Apple, I can buy a closed-end fund that has Apple and Taiwan Semi and Nvidia and Microsoft and Alphabet, and Facebook and Amazon. Like I can buy all of those through a closed-end fund that pays me more than 8%. So the counter narrative against that move, or really against those big picture ideas, like the expanding energy needs and closed-end funds, the counter narrative, which would be where the herd is wrong, and the herd's generally wrong because they're listening to the wrong people, but it's also some of the analysts are wrong. So misunderstanding one, more oil means cheaper oil. Not true. Currently, demand is accelerating faster than supply. Now, gas prices are down year over year, and I think they'll go down further. But gas prices aren't the only derivative of oil. Oil gets put in so many other things, you just don't realize it. Pacemakers, crutches, shoes, phones, refrigerators, flooring, computers, glasses. Without a lot of oil, like if we're outsourcing our oil, the cost of everything goes up. With more oil, the cost of everything goes down. But currently, the demand for oil is on the move, right? It's on the rise. So more oil means cheaper oil, not true. Demand is still increasing. Misunderstanding two. Energy is dead when tech rises. In reality, tech expansion requires energy expansion. If all of these AI or software or technology companies start moving towards natural gas, we don't have the infrastructure for that to happen. We all know the grid is behind, right? But if we're going to have to generate almost say like the size of Japan in energy in the next 10 years to win, winning is subjective, but if we're going to lead the way in the next AI boom, we're going to have to generate or add more energy to the existing grid. Uh, like if we put it in terms of country size, like something about the size of Japan, that's a huge infrastructure investment, right? Expense wise, but also what people are investing because the demand is going up because more and more companies are coming back. So when they add manufacturing plants, that just adds more to the grid. So tech expansion across the board, and then tech expansion, and then tech, it's not a plateau, but tech continuation requires energy expansion. And misunderstanding three, headlines predict markets. False. Headlines guide the herd, and then the herd behavior creates opportunities. So if you think of if you've gone to a rodeo, you'll understand this analogy better, but I'll try to put it in perspective. So if you ever walked next to a cow or a pig or a sheep, you don't want to stand directly behind the animal because A, that's where the refuse goes. And B, pending the size of the animal, sometimes they kick. And you don't want to get kicked by a cow. So you stand to the side. And as handlers walk their animals, they use these little, it's a stick, but it's also kind of like a flapper, depending on person and the animal. And you're tapping the shoulders or the haunches, the hips of the animal in order to get it to move in the right direction. And that's the headlines guiding the herd into what they need to do. The herd goes wherever the herd moves when they sense fear, the herd moves when they sense greed. And the headlines tapping on the shoulders of that pig or goat or whatever, that's what happens to the herd. It's that they're getting guided to where they need to be. Excuse me. And then misunderstanding four, sector pursuit still works. So I found this quote, maybe not that quote, that was my line, but I found what I'm going to say next. I found this quote amongst my weekly reading. And the quote is, current signals favor value stocks in sectors like gold, utilities, healthcare, and biotechs, while technology, notably NVIDIA, shows short-term weakness. Now, the herd isn't seeing that specific quote. And I get it as a free article, but that company offers a paid for membership. But where I'm different, where we're different than that quote, is we're not chasing quarantined sectors. We want to find funds that push the boundaries on sectors and aren't true isolations. Meaning, so this quote, current signals favor value stocks in sectors like gold, utilities, healthcare, biotechs. Those are specific, individualized communities or sectors of stocks. And yes, lots of different companies exist inside those four categories. And then it switches and says, while technology, notably NVIDIA, which NVIDIA is rated at like 4 billion, NVIDIA is almost always overpriced, right? But while technology shows short-term weakness, but that's where they're wrong. And that's what the herd's getting. Technology bubble, technology fear, technology overvalued. The big guys in technology are almost always overvalued, but that's where people put their money. The reality is that all of those other sectors, gold, utilities, healthcare, and biotech, all of those other sectors use technology. You cannot just parse technology out anymore. You can't just treat it as its own category because everybody is using technology. It just matters how they're using technology. So we're not chasing trends. We're using the current market to scoop deals, and we're always looking forward to the coming market. And you have to be able to sift the headlines. You also have to be able to sift the bullet points and sift the articles and sift the analysts. Biggest takeaway, I mean, if nothing less, right? The stock market moves forward like a stumbling toddler chasing a toy, chasing a shiny object. And in this market, it would be growth and profits. It's that toddler is gonna fall down at times and they're gonna bump into things and fall on the floor and cry his eyes out. But he's gonna get back up and chase that shiny object again. And if we're scooping deals for yesterday's market or even today's market, then the toddler's already run past us. My two issues with that quote, the current signals favor value stocks in sectors like gold, utility, healthcare, and biotech, while technology shows short term. My two biggest issues are that A, technology is not by itself, and B, that's advice for today. That's not advice for the what exists in the future. It's a very pigeonholed strategy. It's a very short-sighted vision. So I read it because I like others. I like to hear what other people are thinking. I like other people's points of views. But that's also not to say that I always agree with other people. Case in point. So here's the week's top headlines, or at least here's a selection of the top headlines. So Brett Owens said this in his uh, most recent issue of the Contrarian Outlook, or what is it? CIR, contrarian income. I'm drawing a blank, but at any rate, um, so this is his quote. So while the talking heads hyperventilate about a hard landing, the smart money is positioning for the 2026 recovery. Why? Because the fix is in. We are entering a year of administered growth. The administration has made its wishes clear: lower mortgage rates, cheaper borrowing costs, and a laissez-faire backdrop for American businesses. Kevin Hassett, the likely architect of the new federal policy, says he is going to cut early and cut often. He's not waiting for a recession to lower rates. He's chopping out of the gate. Plus, midterm elections. Politics drives payouts, and we know the administration wants a strong economy heading into midterms. So we're gearing our income strategies accordingly. Contrarian income report. There we go. So Brett Owens sees a slightly bigger picture, right? We had the advice for today, right? Current signals, all that. We had the advice for today, but that doesn't factor in the close future. New Fed chair, new Fed policy, midterm election, strong economy. But even that is still limiting. I think Brett shapes it better for the coming market, but that's still kind of the short term overall in the coming market. But we can use that as a guide to impact our stance on the broader market that's beyond our line of sight. So if we relate them to the ship, the four sectors plus technology, that's like if you were at the very front of your ship looking down, that's what you would see. And Brett Owens' comments about the economy and the coming market and the Federal Reserve chair and rate cuts and looking to the midterms, that would be at some point between your ship and the horizon, right? Depending on what you know, depending on what you know, depending on where you think the market's going, it's not all the way out to the horizon, but it's definitely farther than you dropping a weight over the side of your ship. The question is, what happens beyond your line of sight? Now, no one knows, but we can bet that toddler is going to keep running. And when he hits the midterms, he's just going to keep running. So, where do you think the toddler's running to? Because wherever that is exists beyond your line of sight. And then that becomes your vision. So, hopefully, I haven't lost you. But we're talking bigger picture ideas in a world bigger than just the stock market. We're looking at financial strategy, personal strategy, overall strategy. We're looking at your individual psychological understanding of behavior in the market. We're looking at your ability to predict the market, right? Buying what's in front, like dropping a rock off the front of your ship, buying that doesn't help you. I mean, if anything, you might have just dropped another obstacle for you to hit. Buying somewhat into the future is more helpful, right? When you can anticipate what the market's going to do, we also want to be able to buy beyond that. So, moving next, most analysts are looking for the Fed to cut interest rates by another 0.5% this Wednesday. Maybe, maybe not. Odds are it's increasing. We'll see what happens. And then what has become known as the Santa Claus rally seems to be on, where for whatever reason, it's the Santa Claus rally. The market seems to rise around Christmas time, which is kind of interesting because the herd is currently in fear mode. If you look at the CNN Fear and Greed Index, you'll see that ticker is in fear or extreme fear territory. That doesn't go with a Santa Claus rally. So despite the herd's fears, there is a small bull market charging underneath that white tablecloth. And it's just an interesting stock market right now, right? So regardless of headline, regardless of strategy, The noise changes every week. Sometimes it's louder, sometimes it's quieter, sometimes there's more going on, sometimes there's less. The noise changes. The strategy doesn't. We're creating that no withdrawal portfolio built on high yield assets acquired through existing market deals that focus on where the market's going instead of what the herd fears or instead of what works for today. We're not behind the herd. We are moving in front of the herd. And chances are we are so far out in front of the herd that they might not even hear us. So, in any market, today, tomorrow, 5 years from now, 20 years from now, your job is to ride the tide as best you can. Some days will be better. In theory, you'll know more a year from now than you currently know. You'll have more experience, you'll have more successes and more failures. And the failures don't define you. The failures are simply that didn't work. You learn from it and you keep going. We must ride the tide and we must get better at it. We must get better at sailing that ship and we must get better at both looking forward between where we are and where we and the horizon of what's coming. But we also have to get better at what happens beyond the horizon. So you look at your positions, you look at the discounts, and you go with what makes sense. But it's not like I feel like I should do this. It's does it make sense? Does it fit the strategy? Right? So if we hearken back to what is theorized to come with the Fed, and we listen to Brett Owens, rate cuts plus a growing economy plus an infrastructure boom and technology across sectors, where does that lead you? Like, if somebody told you those things, where would you want to invest? Pretty much anywhere. But if you want the best place for your money, you can't just put it anywhere. You've got to look at what makes the most sense for your individual strategy and where you think the market's going, right? You can put it like there's lots of opportunities, lots of targets on the list for the week. But if we're going to be exceptionally choosy with where we invest, we have to be exceptionally choosy with where we invest. But if you're going to do that and try to get the best deal for your money, you can't just put it anywhere. So where would I put it? And what I've already said: bonds, proxies, end-to-end energy, uh, and then technology beyond the big guys. Like that gives us the best positional. That gives us the best ideal position, which sounds really redundant. That puts us in the best possible position. There we go. For the current market, but also the coming market and for the market that I can't even see yet. So we stick with the system. We stay disciplined. We demand discounts and we buy for the coming market. We scoop deals now that are going to be amazing later. We stay invested, meaning you don't just sell out and freak out like the herd, and we stay ahead of the herd. But for that, I'm past the point of predicting the herd. You cannot predict an irrational creature. You can kind of do it, but you cannot make sense of an illogical mind. So the whole point of I don't follow the herd is that I don't follow the herd. I'm going to do my thing regardless of what they do. Now, I want them to catch up with me, or at least catch up. It's that forever moving line, right? Like I want them to catch up because then that helps my overall profits. But by the time the herd catches up to where I was, I should be in a different place. So What does that mean for the market at large? Like, what's the best thing for us to be in right now? Well, if we look beyond just the those three target areas, bonds and bonds proxies, end-to-end energy and technology, I'll show you the list for the week. And I didn't trim it yet, but I will show you how I trim it. So this is the starter list for the week. All of these are triple asterisks. Um, it's not the full system update because the week was crazy, um, but it's on my list. So we can all of these are triple asterisks. They're all significant. So let's look at when they pay. ASG and USA are tempting right now because they're in discount territory. They're great deals, but they don't pay in a traditional, like category three would be 36912. Category one would pay 14710. These are on a slightly alternate schedule. So my problem is if I buy it now, I don't see a dividend until March. That's a really long time to wait. So and I've done this before. I bought ASG and USA earlier. We should get a dividend payment in January, but at the same time, it makes me hesitate because when I invest money, I want a reward for investing with a company. So that as a monthly reward, if I invest this month and I don't give it and I miss the dividend date for this month, I know I'll get it the next month. But for those, I'll have to wait 2 to 3 months before I get a dividend. And that's just a really long time to wait. Aberdeen, not a huge fan. If so, DX is a great volatility play, but when you're currently dealing with volatility, it's not a great volatility play. I don't know enough about MCN, but I know I'm not a portfolio and a can guy. And I mean, GCV seems to do price wise, I think it stays pretty consistent of what I recall, but it's not the best thing for us. It doesn't really fit my overall investment style. I think we own three quarterly pairs, ASG, USA, and ADX. And I like monthly. Now, if it was, so let's see, I think the next ex dividend date for USA and ASG is mid-January. So if it's mid-January, maybe I'd be down to scoop both of those on a good discount. You look at solid blue chip players who've paid out well and managed the markets well. Like, yes, they're solid with tech companies, and it's not the outright tech companies. And everybody should do better with interest rates being lower. But I still think there's a better deal out there for right now for me. All right. So without those guys, all of these companies have significant discounts. So outside of that, we can look at yield. Now, Oxford Lane has a 32% dividend. That's amazing. It pays monthly. That's amazing. But the CLO market, the collateralized loan obligation market, has been like if the herd is scared and running fearful, the CLO market has been like helter skelter, like like turning the lights on and the roaches just scatter. Like it's crazy. So I'm comfortable being where other people are not, but that marketplace right now makes me uncomfortable. Hicks never does better than the overall market. EIC is still CLO. River has a lot of BlackRock investment. That's not my jam. I don't know enough about Nuveen, but we already own three Nuveen uh, municipal bonds. I really don't want to add a fourth Nuveen fund just for the hell of it. PIMCO I'll keep for now. Aberdeen, I was an Aberdeen shareholder and we sold that. Not a huge fan. PIMCO, Meggy is infrastructure. First Trust is a bond company, as far as I know. CIF is a roller coaster ride on bonds. And we bought CIF when it was super low, knowing it would be a roller coaster ride in the sense of when rates were low, the price was up, and when rates were high, the price was down. So I bought it knowing that, but at the same time, the roller coaster is always my not always my favorite. NVXG is straight tech, DLY is bonds. I've looked at like I deep dove the Eaton verse. Well, I deep dove the Eaton Vance portfolios. They're interesting. They always have been, but sorry, not my intention to yawn. Um, but when I looked at Eaton Vance versus ADX, the Adams ADX, Adams Diversified, I can't remember. Um, but it's too widespread for me. Like it's too diversified. I like I don't think of I've said this before. I don't like diversification for diversification's sake. It's not let's hit everything on the portfolio when it can just to hit everything on portfolio when it can. That's maybe not their style, but that's how it comes off to me. Cohen and Steers, these are pretty similar funds. Um, but I don't want to pay $4 more just to get the same thing. BMES is BlackRock, not my jam. Calamos is kind of like Eaton. Like it's always been interesting, but when if I'm looking at targeted blue chip and AI and technology investments, USA, ASG, and ADX have very small portfolio. They manage a ton of money, but funds wise, I mean, they sit around 100 funds versus Eaton Vance and Calamos. You're looking at 400 to 500 to 800 fund companies. And I honestly love that the ADX, ASG, and USA can do amazingly well with not having 800 companies at their beck and call. Um, let's see. We already have three municipal bonds. KYN is end-to-end energy. Um, it just sits significantly higher than our overall average. So it's a great deal if you have none of it, or I guess it's a great deal if you don't have it in your portfolio. But at the same time, on my end, like it meets the metric, but it's more expensive than it has been, which is what we want. And two, I mean, if I'm being ultra choosy, I mean, I'll get to the end of the list. I'm going to take out everything 9% and under. HFRO is still the biggest discount, but it's come down. Still it's a diversified real estate portfolio, storage, single family rental. It's pretty interesting. Healthcare, but it's not going to meet our dividend. PDX, same thing. It's not going to meet our dividend. I've looked at PIMCO funds for a while simply because of brand name, and they're also set up different than the double line guys, or DSL and DOY. And then this one. So let's eliminate everything under 9%. We'll just make it easy or easier. And we're left with this. So significant discount, monthly payer, 9% or better dividend, Now it comes down to the individual fund price tag in relation to what you have to invest and where you think that it's, yes, all of these would be scooping a deal in the current market, but we're also looking to that gap between our ship and the horizon. We're also thinking of what could happen beyond the horizon. So in the current market with rate cuts, as much as I love the reshoring and the manufacturing and the hope of growth and gains in US stocks, as much as I like that possibility, the best place still seems to be bonds and bonds proxies. If you could find end-to-end tech or end-to-end energy or tech beyond the big guys, those, yes, they're there. But the best place to be still seems like it would be bonds or bonds proxies. So that's bonds, municipals, business development, REITs. In energy as a bonds proxy, utility as a bonds proxy. So let's see what's still here. PIMCO is still interesting, but if you've watched me for a while, I don't like paying for funds that are really 15 more than $15. Um, let's see. HGLB is heavily it's listed as a portfolio when it can, but it's really not. It's technology and a heavy weighting in mid-wave wireless. But on my end of things, it's still valued higher than significantly higher than my current average. PIMCO funds, and I get that I'm all for buying, like the goal is to buy discount. The PIMCO funds are a little different in that we want to buy them or say they get on the list when they are currently priced better than the 52-week average. We should have brought some water, but I didn't. So that puts us here. And of the list, which I mean, it really just feels like a repeat of what I've already said, but especially in past weeks, BRW is a shareholder activist fund who's also into bonds, closed-end funds, crypto, but crypto indices, minerals and metals. FSCO is an all-American based bond company contained inside a closed-end fund structure format, but it's also a business development company. And those three aspects, all American, bonds, and business development, put FCO in just like a prime situation for the current market, the coming market with lower rates, and the future market with hope. I would say hopefully fewer rates, but really in the future market with the trajectory we're on. HUBO is great. On my end personally, it's priced higher than I would like. PIMCO has been on my hit list for a while. Not this specific fund, but just PIMCO. But when I can buy twice as much FSCO, it's hard for me to just do the same. So if I'm going to buy 200 shares there, if I have let's say I have 1,300 bucks, if I can buy 200 shares here, I would just get 100 there for the same price. I wish I could not. Gosh, I wish I could stop coughing. I'm sorry. I'm sorry. It's just going to continue. MBXG is technology, but it's higher. So that leaves me with this. So the best place for me is FSCO. The best place for, well, here, MEGI is utilities, is 50% in the US, 50% outside. And I'm still like, I'm interested when MEGI is, when it's a target, and it's a great target right now. But I still like the all American company feature. And utilities are going to be huge for everybody as technology continues to expand. Like, completely agree. But if we're looking for the best, ultimate, the best place for money, it's really hard to sift out the list and pick that sometimes. I can't understand. I'm sorry, guys. And to do that, we have to sometimes split hairs. And the best place for me is FSCO. And if I could, I would buy BRW because that's really what I've done in sections past. Is I've bought them together. But if I'm really being choosy, the best place, the best buy for me for now, looking forward and then looking beyond, is FSCO. So I know I covered a lot today, and I know I coughed a lot at the end. And I'm sorry, I can't explain it. Besides, uh, the weather's changing and any number of things. So I apologize for the coughing. Um, but we've covered a lot. We've covered the stock market. We've covered personal. We covered how I, this is actually in my books, but how I see myself financially and how we're all learning to better navigate our finances, but also just learning how to better sail our ships across everything that happens to us. So we've talked about a lot. If you like my content, please like the video, drop me a comment, share what you're investing in. Just the cough would go away. Sorry. If you like my content, like the video, drop a comment, share with me. I will happily share more with you, and then share it with a friend. And I hope this helps you. I really do. It's always, I mean, I make these partly to challenge myself and explain what we're doing, but it sometimes it's harder to explain than others. So I like making these videos because it forces me to really explain our strategy and why we're doing it. And I hope it helps you. So whatever you have for the week, I hope it goes well. Whatever you're facing, I hope you have an easier time of it. And regardless of what you're doing, financially and otherwise, it's all financially to a degree, but whatever you're up to, started this so well. Um, no coughing. And then at the end, it's just cratered. Um, so whatever you have for the week, I hope it goes well. Hope you make progress. And by all means, offer me comments and feedback back. At this point, I will take suggestions for evening coughing remedies, even. But if you're whether you're buying, selling, whatever, feel free to drop a comment. I'll interact more. And if you have specific closed-end fund questions or questions about other funds, just let me know. And I wish you a great week, and I will see y'all later. Bye bye.